Okay, picture this. What if your investment portfolio could send you a $2,000 paycheck every single month without you having to sell a single share? It sounds pretty great, right? Well, that's the whole idea we're digging into today, and it all revolves around something called covered call ETFs. So how on earth does it work? Let's break it down. I mean, just think about that phrase for a second. A personal ATM. It just nails the whole concept, doesn't it? This isn't about some far-off retirement number that you can't touch for decades. Nope. We are talking about generating real, actual spendable cash, month in, month out, from the stuff you already have in your portfolio. And yeah, that number isn't just pulled out of thin air. We're talking about $2,000 a month. The person who laid all this out isn't just spitballing here. This is the actual income their portfolio is kicking off. So what's the engine that's actually driving this thing? Let's pop the hood and take a look. But first, we gotta get the mindset right, because this is super important. This is not a get-rich-quick scheme. Not at all. In fact, it's the total opposite. The whole point is consistency. It's about building a financial machine that just pays you steadily, even while you're sleeping. All right, so let's get into the nitty-gritty. How do these things actually work? The source uses this fantastic analogy. They call it the Netflix subscription of income investing. And it makes perfect sense, right? You don't have to do anything special each month. The payment just shows up automatically. So what in the world is a covered call ETF? Well, at its heart, the fund is basically doing two things. First, it owns a bunch of stocks, just like a normal S&P 500 fund might. But then, and this is the magic part, it rents out those stocks by selling something called call options. Think of it like this. The fund is getting paid a fee today in exchange for giving someone the option to buy their stocks later at a slightly higher price. That fee, that little bit of rent money they collect, that's the income that gets passed down to you as a dividend. And this really breaks it down to its simplest parts. The covered part just means the fund actually owns the stocks. It's not gambling on thin air, which is what makes this a pretty conservative strategy. And the call part? Well, that's the option they sell to generate the cash. The best part, though, is that the ETF does all of this for you. It's completely automated. You don't have to touch a single option or worry about any of the complex stuff. And we're not talking about some weird, obscure products here. You're looking at some of the heavy hitters in this space. I mean, if you're an income investor, you've definitely heard of tickers like JEPI and JEPQ. And as you can see, they don't all do the same thing. They track different parts of the market, the S&P 500, the NASDAQ, the Russell 2000, which lets you pull in income from all over. Okay, so let's get personal. Let's look inside the author's actual portfolio to see how this whole thing looks in the real world. I think this is pretty incredible. They started with 25 grand and built it up to over $300,000. And that's the portfolio that's generating that $2,000 a month figure we've been talking about. So here it is, the secret sauce, the specific recipe. And you'll notice right away, it's not all in on one fund. Nope, they're mixing and matching. JEPI for that broad S&P 500 exposure, JEPQ to tap into the NASDAQ, and so on. The reason for this is diversification. It helps make sure the income is steady because, different parts of the market are going to have good months and bad months. And this is where the rubber meets the road. You can see exactly how the math works. Each one of these ETFs has a slightly different yield, right? Some are a bit higher, some a bit lower. Like, look at QYLD. That's kicking off an 11% yield, which brings in about $550 a month. By blending them all together like this, the portfolio just reliably hits that $2,000 monthly goal. And when you zoom out and look at the whole year, the impact is even bigger. I mean, $2,000 a month, that's about $24,000 a year. The author makes a great point. For a lot of people, that's enough to cover a mortgage payment, or pay for a car, or just fund some really cool life goals. And it's all happening passively, just from the portfolio. All right, I know what you might be thinking. This sounds, well, a little too good to be true. And you know the old saying, there is no such thing as a free lunch, especially in investing. To get that juicy, consistent income, you have to give something up. There is a trade-off. So let's talk about the catch. And this lays out the fundamental choice you're making, plain and simple. With a regular old S&P 500 fund, when the market takes off like a rocket, you're on that rocket. You get all the upside. With a covered call ETF, you're basically saying, hey, I'm okay with a lower ceiling on my growth, as long as you pay me a consistent wad of cash right now. You're trading maximum growth tomorrow for reliable income today. And here's a perfect real-world example of that exact trade-off. Take 2023. It was a great year for the market, right? The S&P 500 shot up over 20%. JEPI, one of the most popular covered call ETFs, returned about 10%. So yeah, you missed out on about half of that big growth spurt. But And this is the whole point. You got your cash dividend every single month, like clockwork, the entire way. So, okay, let's say you're cool with that trade-off. You're thinking, you know what, I like the sound of that income. The next obvious question is, how do you actually build this thing? Well, the author lays out a really simple 5-step game plan that they used to get to that $2,000 a month target. And what I love about this approach is how simple and hands-off it is. You just start small, dip your toe in the water and see how it feels. The absolute key is to automate reinvestment, what they call a DRIP, so that every bit of income automatically buys you more shares. That creates this incredible compounding snowball. After that, you just add some diversification, set your income goals, and then you basically leave it alone. Just check in once a year to rebalance. It's built to be super low maintenance. All right, and this brings us to what might actually be the most important piece of this whole puzzle. And believe it or not, it's not about the specific funds or the exact numbers. It's about a total, fundamental shift in your mindset as an investor. The author just nails this description. You know how on a red day when the market's down, a typical growth investor looks at their account and just thinks, oh, there goes all my progress. Well, with this strategy, your brain completely flips. You see a dip and you think, awesome, everything's on sale. My next dividend payment is going to buy way more shares at a discount. It totally changes your relationship with a down market. And in the end, the argument is that understanding the mechanics, that's the easy part. The real challenge is psychological. It's about getting yourself to truly believe that slow, steady, even kind of boring income can be way more powerful in the long run than chasing those fast, flashy, high adrenaline trades. So that really leaves us with one final big question. Now that we've walked through the strategy, looked inside the portfolio, and talked about the mindset, is it worth thinking about for you? Could your portfolio stop being just a number on a screen and actually become your paycheck? It's a pretty powerful idea to chew on.